Hi, my name is Buras, and today we'll be looking at my financial analysis of two different industries with 5 different companies in each industry. We'll be comparing them to each other and picking the best company out of each industry, and then comparing those two companies to each other to find the overall company to invest in. We'll be breaking them down by using the DuPont analysis, which is the breakdown of the ROE. The ROE equals ROA times leverage. The ROA equals profit margin times asset turnover, and your profit margin equals tax burden times your interest burden times your operating margin. Going on to my first industry, I have the home center industry. The 5 companies I chose was Rona, Lowe's, Home Depot, Lumber Liquidators, and Tractor Supply. When looking at the ROE over a 5-year period, we see that Rona has steadily decreased, going into the negatives. We see that Lowe's has pretty much stayed constant, and you see that the other 3 companies are all increasing. Going into my first company, which was Rona, we see that their ROE had decreased into the negative, going from 8.51 to negative 9.33. This was due to their ROA caused by their operating margin dropping and their interest burden going into the negatives. This is the big reason why I did not choose them, was because their ROE did drop into the negatives. Going on to my next company, which is Lowe's, you can see that they pretty much stayed consistent, going from 12.85 to 12.39. Even though that their ROA did drop due to their financial leverage increasing, their ROA did not drop as much as it could have. They also had the lowest asset turnover, and their profit margin also decreased from 4.55 to 3.88. The reason why I did not choose this company was due to their low ROE compared to the other companies. Going on to my next company, which is Home Depot, you can see that their ROE has increased over time, from 12.74 to 25.42. Their ROA has also increased from 5.29 to 11.11, which is due to their asset turnover and profit margin both increasing. The profit margin increased mainly due to their operating margin, which increased from 6.11 to 10.39. The big problem I did have with Home Depot, though, was their high financial leverage. As you can see in this chart, their leverage was higher than all the other companies in their industry, which made them more risky, which is the reason why I did not choose this company. Now, going on to my last 2 companies, it was hard to decide just one, but I will show you which company I chose and why. When looking at Lumber Liquidators, you can see that their ROE had increased from 20.49 to 28.46. But in 2010 and 2011, they had a decrease. This was mainly due to their operating margin, which decreased, which is showing a sign of bad management. Also, their financial leverage has also increased, which is a bad sign showing that they are more risky. Looking at other financial ratios, comparing them to Tractor Supply, you can see that their current ratio is higher, meaning that they are having a better chance of paying off their debt holders. You can see that their WACC is lower, which is a good sign for them. And their market to book is high, and it becomes higher after once 2012 and 2013, and that is showing another good sign for Lumber Liquidators over Tractor Supply. Now, when going on to my next company, which is Tractor Supply, you can see that their ROE had increased from 17.24 to 28.90, which was due because of their ROA increasing from 10.18 to 18.18, and their financial leverage decreasing, which helped them get their big jumps in their ROE and ROA was mainly due to both their asset turnover increasing and their profit margin increasing. Looking at other ratios comparing them to Lumber Liquidators, you can see that their enterprise value is much higher than Lumber Liquidators, which is showing you that they are harder to take over. Along with their PE ratio, which is showing you that they are paying less for a share of equity. The reason why I chose Tractor Supply was due because of their constant growth, and also they didn't have any signs of hindering any future growth for them. Now going on to my next industry, we see that I chose casual restaurants. The 5 companies that I chose was Dine Equity, Red Robin Gourmet Burgers, Cracker Barrel Old Country Store, Brinker International, and Texas Roadhouse. When looking at their ROE over a 5-year period, you can see that Dine Equity had huge fluctuations going from negative to positive. And you can't really see it due to Dine Equity, but Red Robin also didn't have that high of an ROE, with only going as high as 9.85. Now looking at Dine Equity, like I said, their ROE was fluctuating hugely, going to the negatives and positives. This was mainly due to their ROA fluctuating and their high financial leverage, which shows very high risk. This is the reason why I did not choose this company. Now going on to Red Robin, you can see that they increased in their ROE from 6.31 to 9.85. Their ROA had also increased from 2.91 to 5.23, which is a good sign. And their financial leverage decreased, which is another good sign for them. The reason why their ROA increased was because their asset turnover and profit margin both increased. The reason why I did not pick them was because their ROE was just too low compared to the other companies. Now when going on to my next 3 companies, we can see that we have Cracker Barrel. Their ROE went downward from 57.74 to 27.06. Their ROA increased while their financial leverage decreased. Even though their financial leverage did decrease, they still had a high leverage. Also, the reason why their ROA increased was mostly because of their asset turnover increasing and because their profit margin increased, which was due to the operating margin increasing. As you can see, like I said, their financial leverage was decreasing, but they still had a high financial leverage due to their WACC. Cracker Barrel, as you can see, is in the middle between Brinker International and Texas Roadhouse. The reason why I did not pick them was because of their high leverage and them being more risky and still having a lower ROE. Going on to Brinker International, we can see that their ROE had increased from 12.75 to 71.14. As their ROA has increased, so has their financial leverage, which is a bad sign showing that they're more risky. The reason why their ROA had increased is due to their asset turnover increasing slightly, and mostly because of their profit margin increasing, which was done because their operating margin was increased from 3.14 to 9.02. Showing other financial ratios, comparing them against Texas Roadhouse, you can see that their enterprise value is much higher, making them harder to be taken over. And their PE is also lower, like I said before, which means that they are paying less for a share of equity. When looking at Texas Roadhouse, you can see that their ROE has increased from 12.17 to 14.45. Their ROA has also increased, with their financial leverage decreasing. The ROA increased due to the asset turnover increasing and profit margin increasing. Looking at other financial ratios, comparing them to Brinker, you can see that their current ratio is higher than Brinker, showing them that they are having an easier chance of paying off their debt holders, while Brinker International is struggling paying off their debt holders. The reason why I chose Texas Roadhouse is because Brinker's had a high financial leverage, and also they're having trouble paying back their debt holders, while Texas Roadhouse is just constantly growing. So my top 2 companies is Texas Roadhouse and Tractor Supply. When looking at their ROE, you can see that Tractor Supply Company had the highest ROE. Also, they had huge jumps in their ROE compared to Texas Roadhouse. Also, when comparing other financial ratios, Tractor Supply also had outbeat them in most of them, which is the main reason why I chose Tractor Supply, sorry about that, to be my company to invest in.